Hey guys, Adam Rose, Vice President, Senior Loan Officer of Western Ohio Mortgage here in Sydney, Ohio. And this is another episode of the Mortgage Guy Podcast. And today is another market update on what's going on, what's happening, some changes moving, and maybe a couple of tips for some listing agents to try to get some more inventory on the market. So first off, we've talked in the past about how in 2024, the expectation the rates are really dropping. And don't get me wrong, they're on a downward trend and they have come down over the last 3 or 4 months. One of the words on the street was there's going to be 4 cuts made by the Fed, right? 4 major cuts. And they just met yesterday. And I had talked about how, kind of pump the brakes. There are supposed to be some cuts coming, but there's a lot of people on the board that kind of disagree. We're not kind of where we need to be on inflation numbers yet to feel comfortable to start making these cuts and these changes, because it can have a pretty large impact on the market and what can happen to inflation. So they came out yesterday and said there's no change. None. There was a lot of push from Congress about cutting those rates to help get more movement in the home space and the real estate to keep moving that part of the economy forward. But it did not happen. So just to read this off, Fed signals cuts are possible still, but not imminent as it holds rates steady. So the Federal Reserve signaled it was thinking about when to lower interest rates, but hinted a cut wasn't imminent when it held rates steady at its first policy meeting of the year on Wednesday. Central Bank held its benchmark federal funds rate steady in the same range it was before at 5.25 to 5.5. What that is, that's the Fed funds rate at the discount window, and it's highly consequential decision to start the process of lowering interest rates, and we want to get that right. So I had mentioned this, warned about this. Everybody kept talking. The first things are going to start cutting, and their projections on where rates are going to be by the end of the year have dropped even lower than what was expected. And yes, apparently I had my crystal ball and told you that it might not happen as fast because there was some disagreements on how quickly they should be doing it. So just a little announcement there. So no, I told you so. Okay, so let's talk about a few other things. So Fannie Mae came out, and they see some of the issues in our industry right now with, we're downward trend on rates. So more buyers are actually hopping into the market. The problem that we're having is that inventory levels haven't risen at the same rate of buyers trying to jump into the market. So what do we do about it? Now that I had an extra drink of coffee, I can tell you. So what Fannie Mae thinks is we are going to incentivize not the sellers to get more listings, but buyers. Well, I feel that we have enough buyers in the market to kind of fill the needs of the current inventory issues, but they're also trying to make sure that there's not houses sitting for too long either. So they're trying to give some more incentives. Fannie Mae said they're going to give $2,500 rebate. So what this is, real fast, is it comes from the lender, and then the lender gets reimbursed. So it's a $2,500 credit towards closing costs, down payment, what have you, if you are using home ready financing. All right, so home ready, Fannie Mae specific product. Home Possible is a Freddie product. They're almost identical. So we're going to focus in on Fannie. They're pretty much the same program. All right, it's a 3% down conventional loan. Fantastic product. Anytime we have somebody that qualifies for conventional financing, that's a lot of times the first bucket that we look at to see if we can fit them in there. And the reason I say fit them in there is because they have some restrictions. All right, the main thing that they have is an income restriction. You have to be right around, it's 80% of the area median income, gross median income, by the way. And it's, so in our area, it's like $70,400, $74,000. It's right in that ballpark, right? The CAV, and it's a great program. It's got lower mortgage insurance. The interest rates are usually a little bit more attractive than even doing a 5% down conventional option. Fantastic. So in order to get this $2,500, though, there's a caveat. Not only do you have to qualify for Home Ready program, but they said that now, in order to get the credit, you have to have your income at 50% of the area median income. So it's going to be a little bit more challenging, right? So we're going to knock another $30,000 off of your income or $25,000 off your income, and now you have to qualify in that range. Not saying it's not possible, but it will be a little bit more challenging in order to qualify for certain homes or price points in this market at that income level and stay in conventional financing because they're a little bit more restrictive on your debt-to-income ratio, right? It's not FHA, where you can go up to 56.99% and still qualify. You got to be at 49.9% or less. And even at that 49%, it doesn't always happen, right? That their preferred is 45 and under. But we do see approvals at the 49 range. So good news from Fannie, but at the same time, they always have to throw something in there, which is just not going to make it easy for everybody to qualify for. So goods and bads there. Nice try, Fannie. Hopefully it works, but I'm not overly confident in that. So let's talk about 2-1 buydowns. All right, so let's talk about inventory issues and ideas on how to get some more listings out there in the market. So if you're a listing agent listening to this, and I'm sure you already know this, it's not something that I'm telling you that you haven't heard before, but I want to revisit 2-1 buydowns, 3-2-1 buydowns, 1-0 buydowns, what have you. Okay, so I think a lot of the pushback that we're still getting from people wanting to list their home is, I'm still got this 2.5 rate, this 3.5% rate, whatever it might be, and rates are still at the 6.5 range, right? Something in that ballpark. And I just don't want to list yet. It's just not the right time for me. I hear rates are still trending downward. I'm going to wait. So we've been talking about, people that have been buying over the last 18 months that might be in the upper 6s and the upper 7s, mid 7s, what have you, is they're going to be refinancing at some point, right? Because we are on a downward trend. We expect rates to hit back into the 5s sometime next year, and they're going to refinance and they're going to be good to go. So how do we get more people to jump on the listing bandwagon so all these people that are shopping right now can enter the market? 2-1 buydowns, 3-2-1 buydowns, 1-0 buydowns. All right. So one of the things that you can talk to your clients about that might be on the edge about, hey, I'm going to wait till the end of the year, or hey, I'm going to wait till next spring until the rates are back into the 5s, is discussing not only offering this to potential buyers, but when they go, if they decide to list and they're shopping, to negotiate this with their potential seller. Okay. So 2-1 buydowns, how does it work? So let's say today's rate is 6.5%. Okay, across the board. So what's going to happen is you are prepaying the interest difference. All right, prepaying. It's not a permanent buy down. All right, permanent buy downs, you don't get quite as much bang for your buck. So let me give you the example. You got a 6.5% rate. The seller says they will pay for your buy down because it has to be seller paid. All right, you personally as the buyer cannot do it. All right, so let's say we do a 2-1 buy down. So year one, you're going to be at a 4.5% rate. Year two, 5.5%. Year three, back to the par rate of what you were getting quoted that day, 6.5. Okay. What this does is it's buying you time for the market to shift so you can get into refinancing position at the lowest rate that you can find at that point. Okay. But what this will do is buy you some time and get you into a price point, or the monthly payment that's more palatable. And we can kind of just time the market better, right? So example, if you started at 6.5 and we go down to 4.5 in year one, what you're doing is you're paying the difference in the interest of 4.5 and 6.5. That is $3,009 in this example. And we'll pop something up for you to reference. There's a lot of online calculators. You can check it out too, okay? And then we're going to do the interest calculation difference between a 5.5 and a 6.5 in year two. That total is $4,551. Almost 52. So $4,552. So in lieu of asking seller, hey, Mr. Seller, I want you to cover $4,500 towards my closing costs, you can say, hey, I want you to cover $4,500 on my temporary buy down. You can put that in the contract, and then we're going to qualify you off the 6.5 just to make sure you still qualify, of course. But year one, your rate is based off of 4.5. Year two, payments based off of 5.5, and then year three is 6.5. So it buys you that time for this market to continue trending downwards, and you can get into that 30-year fixed rate mortgage, or a 15-year possibly, when the rates drop enough for you to get it refinanced and be more comfortable. So guys, let's start using that. It's very, very underutilized, and there's a lot of lenders out there that do it, and they advertise it as well, but I just don't feel like it's talked about enough, and it's not being used. So use that, put that in your tool belt. If you're talking to a potential client who wants to list their home, but one of their objection is the rates. I just want to wait a little bit longer because of the rates. This is the solution. All right. So use it, market it. Make sure your agents that work for you are aware of it, and all your clients are aware of it as an option, and make sure it's a negotiation tactic you are using. That's it this week, guys. I hope you have a phenomenal week. Please keep your fingers crossed that this market picks up in regards to inventory. Again, rates are trending downwards. That's the takeaway. They're not going to move in the next couple of weeks anyways, but they're going to stay steady. So we're looking pretty good there. Now we just need to get the inventory. So remember, check us out on YouTube and subscribe. Check us out on Apple Podcasts and Spotify, and we will catch you all next week.